Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, investors, traders, strategists, authors, educators, anyone we can to understand their perspective, to learn a little bit more about their lessons learned through the course of their career, and to focus on actionable opportunities and ideas during uncertain market times. Today, I'm excited to share with you a recent conversation I had with Lindsey Bell. Lindsay is the Chief Market Strategist at Clearnomics. I had heard of Lindsay a number of times from peers in the industry, but hadn't had a chance to meet Lindsay in person. I was really excited to sit down with her at the recent Las Vegas MoneyShow. Be warned, the audio is not ideal because we were doing the podcast interview in the middle of a busy and heavily trafficked exhibition hall, but I hope that Lindsay's expertise and her thoughtful comments and perspective on the current market environment shine through what may not be the most perfect audio experience of your podcasting life. I had a lot of fun talking with Lindsay about current market environment, and again, we recorded this kind of mid-February of 2025. We compared, and the presentation she was giving later that day was comparing 2025 to 1995. And it was interesting talking about kind of a mid-stage bull market year of 1995 versus some of the trends she was observing here in early 2025. We talked about the Magnificent Seven stocks, which had already started to have a bit of a pullback, a bit of a rotation, and where some of the leadership themes could emerge. Probably not small caps. That was one thing we talked about for sure. Still waiting, but we covered a lot of different things. Talked about the AI growth prospects beyond what we've experienced so far in 2024 into 2025. Talked about increased competition in the AI space and how some of the best opportunities could come outside of those Magnificent Seven stocks and maybe into some other areas of emerging market leadership. We really focused on capital expenditures, the aggressive amounts of money that some of those leading names are spending on AI, but again, how the leadership could be a little more diversified. Also touched on the Fed. We talked about combining macro and micro perspectives as an investor. We're talking about short-term pullbacks in Nvidia's recent issue with the Deepseek AI news, how it was able to recover, how the future may still be in question going into March. Talked about gold continuing to outperform in 2025, risk management, and how to cushion yourself from potential market downside as an investor. Lindsay, I learned, is on the board of a group called Better Investing, really focused on educating individual investors. And toward the end, I asked her where she thought individual investors could stand to learn the most about investing. I think you'll appreciate very much her answer. I know I did. So please enjoy this recent conversation with Lindsey Bell, Chief Market Strategist of Clearnomics. So super excited to be sitting down here at the Las Vegas MoneyShow with Lindsey Bell. Lindsay just recently joined Clearnomics as their Chief Market Strategist. Lindsay, it's so good to meet you in person, and thanks for sitting down with me. I appreciate it.
Thanks for having me. I'm so excited to be here with you at the Money Show.
Right. So tell me this. You're doing a presentation coming up here later today called Economic Shift Drives a 1995-like Market. That is an interesting sort of analog comparing 2025 to 95. I mean, for those that don't know their market history, pretty strong year for stocks. What makes that relationship meaningful to you? Why is that a good comparison to make, do you think?
Well, I guess I'm really comparing the decade of the 90s with the current decade that we're in.
Sure.
And I think that there's similarities and there are differences.
Okay.
And the similarities really stem around worker shortages and people working multiple jobs, which isn't the place that a lot of people will start when they talk about the comparison of the 90s with today.
Sure.
But that was an important component of it. But then there's the interest rate environment was elevated,
For
5
sure.
to 7% throughout the decade.
Yep.
Inflation was elevated, 3%, although I will say the rise in inflation wasn't as swift as what we've seen this time around.
Yes.
And the slowdown was better in the second half. So
That's
we
true.
don't know where we're going with inflation.
But similarities, I mean, in terms of inflation, because the Fed kind of did a similar thing, they started cutting rates, 1995 ended up being fairly strong. I guess the difference now is we've had a big area of the market, the Magnificent Seven stocks, that were so strong in 2024. How does that fit into your thinking when you're evaluating the conditions here in February of 2025, coming off such a strong year for some of those names?
Well, I think, but when I look at the market now, I think that what we're seeing as we start into 2025 is a digestion in the market, right? I mean, you're the technician, you tell me.
That's a fair verb. I like that, the digestion. Yeah, it's good. Yeah.
So we're seeing a digestion, but we're also seeing a rotation.
Yes.
So other parts of the market are starting to pick up the slack for the slowing growth that we're seeing from the Magnificent Seven, or even the tech group in general, which is converging with the rest of the market or some of the other higher growth areas of the market.
Yeah.
And so what I think that you're seeing this time around is you're seeing the diversification widen. And that's really important, an important component of a healthy market.
I was going to say, arguably a healthier environment than we saw before, which felt very narrow, right?
Right. Yeah. But I think right now what people are really focusing on is this rotation into the value-oriented sectors. So you're seeing financials do well, you're seeing materials pick up. Maybe that's a reversion to the mean type of trade, but you're seeing healthcare also do well, and consumer staples. So these things are happening, and it's been well documented and well talked about. But what people are less talking about is the rotation within the technology sectors, which would include technology and communication services sectors that is occurring. And I think that's really a healthy trend. It's not a falling out of bed of these Magnificent Seven or these big tech stocks. It's kind of a rotation or a look for, and I think you're seeing this across the market, it's a look for better valuations, almost like a GARP type search, right? Growth at a reasonable price. And so what you're seeing within technology, look at the Cisco's, look at the IBM's, look at Accenture within information technology sector. Those are the names that are picking up the slack from the bigger, heavier weighted market caps within that sector. When you look at communication services, Netflix is not getting any love here. They're
but a decent, I was going to say, decent returns, right?
Yeah, and then you got Take-Two and you got Match. Those stocks are up and they're hanging in there. Maybe they're not as big of a secular trend, but
so less of growth to value, more growth to other growth, right? I guess diversifying away from the Mag 7. When you're evaluating some of those previous leadership names, Meta kind of the outlier in that it just hasn't even stopped. It's continued to go higher, but a lot of Alphabet and others kind of pullback mode here. Do you see those as tactical pullbacks within a longer term healthy environment, or do you see signs for concern based on valuations or other metrics that would tell you we want to be leaning away from some of those previous leaders? How do you sort of treat those Mag 7 names here in February of 25?
Well, I definitely think that the pullback that we're seeing in the Mag 7 names absolutely has to do with valuations that have gotten pretty stretched. If you look at tech in general, 27, 28 times versus the market at 22 times, which is also expensive. But tech, the premium that you're paying is twice as much what the historical average is. So valuation is certainly a concern within those sectors or in those specific stocks too. I think when you look at Meta, not that it's that much cheaper, I think that you're seeing maybe that's a second derivative trade of the AI play, right? There's concern about competition, and not just from China, but globally. A lot of these other countries are just getting their AI programs started. So the question is, what's the return on investment going to be? So I think that there's been a pullback in some of these like picks and shovel type of names related to the AI trade, and there's growth in, or there's interest in some of the areas that might be the second derivative or third derivative play that could benefit from the growth of the AI expansion into other sectors and industries.
So it's an interesting, when you're talking about a 95 analog, I don't remember exactly when like Netscape went public, but it was right around that time, probably mid those mid 90s years. Do you and then of course the late 90s were all about the tech bubble, kind of the left side of that. Do you feel like that is where we're at in the AI cycle, where we may just be beginning, and maybe it's some other names we're not as familiar with that become part of that? Like, where are we at in that AI sort of phase? Again, after an incredible run in 24, is there more to come there?
Yeah, I think there is more to come. There's more opportunity for competition to come in. I think what we're learning is that it's not just, while these companies, the Mag 7, have the biggest cash flows and they have the cash to spend and invest in CapEx. Four of them are going to spend over $300 billion just in 2025 on CapEx and AI spend. So that's a big number, but what we're learning is you don't necessarily need that, potentially don't need that type of spend to create a competitive product. And so I think that there is more opportunity, but the thing that I'm more interested in, again, moving away from the picks and shovels, is really what is the opportunity across industries, across sectors? What's the margin and productivity opportunity? Because what we did see in the 90s was an increase in productivity. It averaged about over 2%, 2.2%, something like that during the decade, but the second half is really where the productivity picked up. And if you think about when ChatGPT really came to market, it was in this latter part of 2022.
Sure.
And I think businesses and consumers alike are still just getting their feet wet with using this new technology and how it's going to improve productivity. So I think there is that opportunity potentially in the latter part of the year. There's no guarantees, because I think neither of us are major experts when it comes to AI. At least I'm not. Maybe you are. But I think that's where maybe the hopium lies.
Yes.
And I think it's healthy that it's not just lying in these bigger stocks. But the question was, how does the AI opportunity relate for the big guys?
Yes.
They're making the spend. There's the concern about competition. But when you look at these companies, this isn't the late 90s moment. These are companies with significant cash flow, with robust margins.
Very different structures, yeah.
They're almost like the conglomerates of the industrial age, right?
Yeah.
Back then.
Yeah.
So even though they're investing and growing in the AI market, they also have a lot of other businesses that are big and meaningful
and doing pretty well, right?
And sustainable. So even if the AI bubble bursts, they've got this to fall back on.
A bunch of other stuff. So. What you'd mentioned, CapEx, on your social media accounts, you shared a chart showing the year-over-year CapEx spend, and it's kind of going vertical, right? I mean, it's exponentially rising. You are much more familiar with the fundamentals of these companies than I am. How does that end? I mean, there's a theoretical point where you just can't spend any more money than they're doing. How does that, I mean, is that evolve in some positive way, or should I be concerned about, like one of the arguments like Apple with iPhones, like at some point, everyone that's going to have an iPhone already has it, and then what? Are we getting to that, do we get to that point with CapEx with some of these larger names where there's just no more growth to be had? What does the future kind of look like when you look down a couple of years on those stocks?
Well, so that's the thing. I listen to Dan Ives when it comes to this type of thing, because he's had it right, and he's really been in the weeds of it. I think he's in Southeast Asia right now trying to figure out what the demand actually is. But when he'll talk about it, he says it's a multi-year $3 trillion investment that's going to be spent globally. Yeah. So I think there's a couple more years of spending to come, at least based on his analysis. Again, I'm not a tech analyst, but I think there is more to come. Yeah. And the question is, how does that spread across sectors? And so I think that's, for investors, that's the important part, is that diversification really truly is important. When you look at the market overall, over long periods of time, it's actually the equal weight index that will outperform. And even if you look at the past 15, 20 years, the equal weight S&P 500 index has outperformed the S&P 500. And historically, you look at the market, the largest companies in the market have really been the boring companies, and what they really do, it's like the GEs of the world for a long period of time. And what they're there for stability, they're there for dividend growth. Yes. Like we're not quite there with the tech names, but they're becoming conglomerates. They are becoming diversified businesses themselves. And so I think that maybe it's not such a bad thing. But again, diversification is important.
Tell me this, so your new role is at Clearnomics. That obviously, congratulations on the new role, that's fantastic. Tell me about that role. What is Clearnomics trying to accomplish? How do you fit into the story there?
So Clearnomics has actually been around since 2017. They are a platform that provides market and economic insights for the wealth management and asset management industry.
Got it.
My role will be creating a lot of those insights and utilizing the charts and things that we have for advisors or other clients to really use, to put it at their fingertips, for them to be able to customize it and be able to share it with their clients very quickly and easily.
Fantastic. So if you're writing a note to them today about the Fed and where we're at sort of in that cycle, again, sort of thinking of where we're at now versus 95, we have this period where the Fed started to lower rates. Now we've sort of are in pause mode. How much is Fed policy in 2025 fit into the story for you? How much are you concerned or optimistic based on what you see the Fed trajectory from here?
I think when it comes to the Fed, it depends on what the market expectations are. And I think what we've seen is a recalibration, if I can use that word, of what is expected from the Fed. And the market has moved to, we are in pause mode, at least investors are predicting that.
And that was a lot less painful than I feel like it could have been, right?
It was less painful than in 2023 when we thought we were going to get all of these rate cuts, 7, 8, and we got, I don't even remember, but zero, right? So it was much more difficult in 2023 than it is in 2025. Yes. But I think that the trajectory is really going to depend and be dependent upon what happens with inflation, right? What happens with the job market. And so tariffs obviously play a role in that. Fiscal policy is going to play a role into that. And so I think that the market, it's going to create volatility, which, as you know, creates opportunity for investors.
And no volatility means not a lot of opportunities for investors, unfortunately. So tell me this, we're at one of those periods, and I feel like there are times when investing feels like a macro call, where you're just trying to understand how tariffs and geopolitical issues and inflation, how they all triangulate. There are other times when that's kind of working and it's more about stock picking and individual stocks. How do you kind of combine the macro versus the micro? How do you coach investors to try to do that and not lose their mind in the process?
Well, there's always fundamental opportunities to be found. I mean, that's the fundamentalist in me talking, right?
In any market, right? I mean, there's usually something,
But I laughed when you asked the question because, for at least 2 years running, I'm like, this is the year we're going to focus on fundamentals. It's not going to be all about the macro. It's not going to be all about interest rates and inflation.
But here we are.
Here we are. It's going to be March before we know it. And the first quarter will be under our belt, and I still think it's really a macro environment. Yes. I think that the Trump administration is ensuring that it stays that way, at least in the near term. And so I think that you can't be so reactionary to every headline. And I think it's really all about finding the disconnects. What's the headline versus what's happening underneath of the surface. I mean, everybody's like, Trump's going to be hard on China, right? But look at some of the stocks and the market over there. It's like it's doing really well.
That's right.
In an environment that's supposed to be weak from an economic perspective. So
right.
So it's just looking for disconnects at all times, and I think that's what you do too, right? As a technical trader.
For sure, right? The goal is to kind of find that gap between what maybe should happen, what actually is happening when you look at the market movements. Tell me this. So recently with Nvidia, and it feels like years ago, but it was only a couple weeks ago, we had the Deepseek AI news came out. All of a sudden, Nvidia, high-flying name, comes off of new highs, down 20-some% overnight. Now that's all erased, it's coming right back. How do you sort of navigate through those short-term dislocations that I feel like a lot of investors struggled mightily, and it felt like that was the end of AI, and then all of a sudden it's gone? How do you sort of navigate through those short-term disruptions and stay focused on the long-term appropriately?
Well, I think when you look at a situation like that, it's the same on the downside as the upside, right? The market can be irrational for much longer on the downside or the upside than might make sense rationally, right?
Sure.
So I think it's really just like keeping your head about you, thinking about, like we just talked about, it's the macro environment that's really driving the market right now. So keeping an eye on what's really happening from a macro perspective. And really determining if something like that's taking the whole market down, is this an opportunity? Like we said with volatility, is this an opportunity or not? Has the macro environment changed significantly? Like if we get mass tariffs that are going to change the environment entirely and push the tax on the consumer up significantly, that's a big change. Right. And I think the market's trying to assess that on a day in and day out basis. So, you got to keep your eye on the market, but you got to kind of think longer term too.
I like it. One thing that I noticed you've not mentioned in particular in our conversation yet is anything related to small caps. We talked about big names doing big things. I feel like the return of small caps has been announced a number of times in recent years, still waiting. Do you see that as an opportunity sort of evolving in 2025? Why or why not?
Yeah, that's a good question. I think, everybody's waiting for the resurgence of the small cap sector. You've seen puts and takes, I think, with regards to that. I think with the Trump administration, it should be an environment where the small caps do well, but when interest rates remain elevated, that makes it makes that trade a little bit more difficult. So I think that's that's like kind of in a show me situation.
Yeah, right.
So I think it's hard to just go all in on that right now. I think it's going to depend on a lot of different things.
Yeah.
But it does, when I talk about diversification, there could be opportunity there when you think about the concentration risk that you have with the Mag 7 or even the tech sector in general in the larger cap index. You know, rebalancing and making sure that you have exposure to the, if not the small caps, the mid caps, I think makes sense.
And I feel like for a lot of individual investors, they probably become way more concentrated in those big names that have had big runs than probably they realize or they need to realize. One thing that's done remarkably well that is not involving AI or anything is gold, which for much of 2024 outperformed the S&P, the NASDAQ, and all that. Year to date, gold is outperforming those major indexes. Do you see that as an area? You mentioned materials, starting to do well. Do you see gold as a continuing opportunity? Would you be allocating to something like gold here? Or do you think it's had its run and you need to be focusing elsewhere?
I think there's always a place in a portfolio for commodities, right? And so I think the run in gold has been really impressive. This is this is supposed to be the steady investment class, right? But I think that, what is that? Is that signaling something about inflation that we should be concerned about? Is it because interest rates, we're supposed to move down? Like, is it the Trump trade? So I think it's really understanding what's the key driver behind that is what we really need to assess. I don't think you own gold for big returns. Like, that's not what its purpose should be in your portfolio. Again, it should be a stability component of your portfolio.
Right. But having at least a portion in there seems like it would make sense. So tell me this, in 2025, what does risk management mean to you? I mean, how should individual investors be thinking about risk? Again, I think there's a lot of concerns about, again, macroeconomic factors, geopolitical risk, and what could happen. How should I feel like institutional investors tend to have a really good risk management approach usually, hopefully, but individual investors kind of struggle that. What should define good risk management for an individual investor, do you think?
Yeah, I think it's taking a look at your portfolio on a consistent basis. It doesn't mean you have
actually
to
looking at it, right?
Actually looking at it. It doesn't mean you have to look at it every single day or even every single week because when we are in a volatile market, it's better to zoom out, right, than to be in the weeds of it all. But I think it's looking at your portfolio, again, assessing where the weights in your portfolio and making sure that it's balanced across not just sectors and industries or even capitalization classes, but asset classes, just like we talked about gold, and also internationally. So really having a balanced portfolio, I think, is really important from a long-term perspective. But then also thinking about where you at, what your financial goals are, and what your timelines are too. So different asset classes provide different returns and different potential depending on what you're looking to do. So I think talking to a professional too. I mean, that's what we rely on the advisors and asset managers that are our clients at Clearnomics to really have those conversations with their customer base because timing is everything.
For sure. What makes you nervous here when we're in Q1 of 2025? And we've talked about a number of things that are happening right now. We've talked about different potential future paths. When you're looking at market conditions now, what's that thing or those things that make you nervous that you think is where the market's the most vulnerable?
So I think the consumer has been super resilient over the last several years to the surprise of many, right? And I think that we're reaching a tipping point with regards to price sensitivity for the consumer. So it makes the tariff conversation extra fragile. And I think that you're seeing the response of consumers with regards to prices dictate where and when they spend their money. I mean, I think in the December retail sales report, you saw that there was a pullback on spending on eating out, food and drink places because they were using that part of their budget to buy gifts, right? That bounced back. That bounced back in January, and then we saw a decline in online sales. So not a decline, but a slowdown. And so I think that the consumer is continue to be discerning. There was one point that we're going to get this week earnings from a lot of the retailers. There was one point where a lot of them, Walmart, Target, they used that word discerning about the consumer. And I think you're going to hear that more. You're starting to see delinquency rates rise. You're starting to see consumer credit increase. It doesn't mean they can't manage the situation, but I think it's something to be mindful of. And I think in conjunction with that is the job market. So it's not just about prices and inflation, it's the job market, which there's 8 million jobs open right now. So there's opportunity in the job market. I think the problem for the consumer is the minimum wage increases. I know from a headline perspective, we got that hot wage increase in the January report, up 4.1%. Right. But if you look at the quality of the jobs that are being added, you look at the places where those wages are increasing, it's on the low end, it's in the service jobs. There's of course healthcare and government jobs that are being added, and you're starting to see very early green shoots, I think, in the information technology, finance, and professional business services areas, which are higher earning middle income jobs. Real wage growth for the middle income has been weak over the last 4 or 5 years, and so I think that there's some puts and takes for the consumer. Doesn't mean they can't continue to be resilient, but that's one area that I'm going to watch that isn't the big macro concerns that are clear and
super
on the table.
helpful. One final question, Lindsay. I know you've spent time on the board of Better Investing, an educational platform to help individual investors. What do you think individual investors struggle with the most, or where is there the biggest need for education for individuals?
Hands down, it's the time that you need to spend to learn how to invest. And we at Better Investing,
it's a process, right?
It's a process, and we have a platform that makes it extremely easy for you to understand how to get started investing and picking individual securities. And of course, we're focused on value-oriented stocks. We're focused on continuously investing in the market over a long period of time and staying invested for a long period of time. But you have to take the time to learn the process, to learn what a PE ratio is, to learn what good sales and earnings growth looks like, to understand balance sheets and how that is important in analyzing individual securities. And so I think that it's really a time component. And then it's also just having money to invest in the market too. So those two things.
Lindsay, this is fantastic. It's so good. I've heard wonderful things about you, and I see why. It's really helpful to get your take on the markets. And thanks for everything you're doing to help individual investors make some better decisions. So thanks so much.
Of course. Thank you for having me. This is a great
conversation. And enjoy the rest of the show, right?
You too.
So there we go. What a fun conversation. Lindsay, was an absolute pleasure to get to know a bit, and I hope I'm able to get her back on the podcast later this year as we sort of continue to navigate these markets in uncertain times. Thought some of her thoughts on emerging strength outside of the Magnificent Seven names, but maybe into other technology names, right? Sort of instead of growth to value, maybe growth to other growth is something to think about. I don't think that particular thesis is aired as often as it probably should. Really appreciated her comments on risk management, on where individual investors could stand to improve their education, just combining the macro and micro disciplines. I really appreciated Lindsay's ability to sort of combine the big picture with some of the more narrow themes that we can find with individual stocks. Overall, really fun conversation. I hope you appreciated it as well. As you think about some of the themes that we talked about, and Lindsay had mentioned in our conversation, I'm the technician, so you know better than I do about a certain trend. If you want to learn more about those technical tools that me and other technical analysts and technical aficionados apply to the market environment to really track trends and identify areas of emerging strength from a technical perspective, our Market Misbehavior Premium memberships may be a really good gift to yourself here as we continue on the first quarter of 2025, navigating challenging periods. 3 great benefits of the premium membership. Number 1, access to virtual courses. We're actually working on our latest virtual course focusing on specific technical indicators. You'll have access to all of those on demand at your own pace. Second thing, some premium members only reports like our weekly flight plan, which comes out every weekend, and our monthly chart review. Next one will come out at the beginning of March, where we focus on long-term trends and shifts and applying our proprietary market trend model to a series of ETFs and asset classes. Finally, I have access to a premium members only community where you can ask questions. I'm in there every day answering questions from some of our premium members. You might find some of my longtime members weighing in and giving you some thoughts and expertise as well. You can find more information on our website at marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. Some other great conversations from the Las Vegas Money Show will be coming your way here over the next week or so, and I hope you enjoy them all. For Market Misbehavior, I'm Dave Keller, and remember, it's always a good time to own good charts.